Good evening, ladies and gentlemen, and welcome to H World News. In a world where digital communication is king, the banking sector is undergoing a profound transformation in how it manages employee interactions. The catalyst for this change is the looming shadow of billion-dollar fines and the ever-present specter of compliance issues. Global banks, including banking behemoth HSBC, are making unprecedented moves to tighten their grip on how their employees communicate, particularly through the prevalent use of instant messaging apps like Slack and WhatsApp. A recent report confirmed that HSBC is taking the remarkable step of blocking text messaging on work phones, a development that stems from a monumental $549 million fine imposed this year on 11 brokerage and investment firms. The Securities and Exchange Commission and the Commodity Futures Trading Commission wielded this financial hammer over the use of messaging apps, signaling a sea change in how financial institutions approach communication. Why are banks suddenly cracking down on their staff's digital exchanges? The answer lies in compliance. Banks are required to rigorously adhere to regulations governing the use and preservation of employee communications, and these rules are becoming even more stringent. The challenge stems from the use of messaging apps like WhatsApp and Signal, which are often linked to personal devices and pose significant monitoring and record-keeping difficulties for compliance departments. HSBC's move to ban work-related texting is a preemptive response to potential future missteps and fines, given that financial institutions are on edge about compliance breaches. Notably, HSBC paid the CFTC $75 million in penalties earlier this year due to what the regulator described as manipulative and deceptive trading and record-keeping failures. This wasn't an isolated incident. HSBC also shelled out $15 million to the SEC for its improper use of WhatsApp. The crackdown isn't limited to HSBC. Private equity giants like the Carlyle Group and Blackstone are reportedly under investigation for their use of WhatsApp and Signal for discussing business matters. Furthermore, lenders such as Bank of America, Wells Fargo, and Citigroup have had to part with over $2.5 billion in the past year alone for similar record-keeping infractions. What we're witnessing is a broader regulatory drive, with regulators scrutinizing how the financial industry handles electronic communications on personal devices. The SEC's investigation unearthed what it termed pervasive and long-standing off-channel communications at a number of banks, highlighting the systemic nature of the issue. It's not just about punishing past offenders. The SEC has indicated that more regulatory action is on the horizon. According to Sanjay Wadhwa, the SEC's Deputy Director of Enforcement, record-keeping failures such as those here undermine our ability to exercise effective regulatory oversight, often at the expense of investors. The SEC is determined to ensure industry-wide compliance, signaling that the winds of change are blowing through the world of banking digital communications. In conclusion, billion-dollar fines have thrust the banking industry into a new era of oversight and compliance. The widespread use of instant messaging apps has forced banks to adapt, cracking down on employee communications in an effort to avoid further regulatory missteps. The days of casual text exchanges about business matters seem to be numbered, as banks brace for a future where every digital interaction is subject to scrutiny and record-keeping. The message is clear. The banking industry is undergoing a digital communication revolution, driven by the hefty fines of today and the promise of more regulatory action tomorrow. Remember to like and subscribe if you would like to hear more news stories like this.